It's the absolute classic property investor question. Should you chase cash flow or capital growth? Both have their benefits and their trade-offs. Cash flow gives you the ability to hold the property for the long term and maybe some income now. Good luck with that. While capital growth builds long-term wealth. But here's the good news. The right suburb can deliver a mix of both. You just need to know what to look for. So let's explore how smart location choices can help you avoid the either-or trap and find that sweet spot of income and upside. Hello everybody. Are you ready to make smarter property investment decisions? I hope so. I am Kate Hill, qualified property investment advisor, and I am here to help you cut through all the noise with honest, no hype advice. Real strategies, real tips, zero fluff. Today I am asking you, are you chasing cash flow or capital growth? Let us discuss how the right location can offer you both. Cash flow, as I'm sure you all know, you're all smart cookies. It's the rental income left over after you have paid your property expenses, including the mortgage, the biggie. The cash flow outcome of a property will be individual to each investor's. The marginal tax rate, the loan structure, the location and basic yield of the property. The same property with the same rent can have a very different cash flow outcome depending on who's buying it. That is really, really important to understand before you buy. A cash flow that you can afford can improve your borrowing capacity. It eases financial pressure and helps you hold onto a property for the long term, which is important. Capital growth is the increase in the property's value over time. It's what helps you build real equity, refinance and leverage into more assets. While it may not cover all the annual bills right now, it is crucial for long-term wealth. Some suburbs, especially in key regional cities or outer capital and metro corridors, offer a balance of solid rental yields and long-term growth potential. Now, these aren't unicorns. They are just overlooked by a lot of investors who only chase the big city growth, the alleged big city growth, or the ultra high yield. And remember, it's all about a cash flow that you can afford. You, the investor, it's going to be different for everybody. So these corridors usually feature affordable entry prices, tightening vacancy rates, infrastructure investment, and proximity to jobs. Renter demand drives your income, while future population growth, economic growth, and demand for that property from other buyers will drive your capital gain. Chasing an ultra high yield in a low growth area generally leads to portfolio stagnation. A great rental return today is not going to help you if the property never grows in value or declines in value or becomes harder to sell later. Some investors buy into hot suburbs with negative cash flow, hoping for massive growth. But if that growth stalls, becomes a bit lackluster, interest rate rises, holding the property can become financially painful. And the capital growth has to be then truly superior to make up for all that cash that you're losing, that you're paying into it to keep it every week. So look for areas with vacancy rates ideally under 3% or 1.5% as well, and rising rental prices. It indicates strong tenant demand, which supports your cash flow and future rent increases. The demand for rentals has to be consistent. You want to get in before the crowd. Check for suburbs with announced and funded infrastructure, growing population, new employers, affordability compared to neighbouring areas. These signs often signal future capital growth. Cash flow and capital growth don't have to be a trade-off, not if you focus on locations that can offer you both. With the right strategy backed by solid data, you can build a balanced portfolio that supports you now and in the future. And that is what smart investing is all about. As always, everyone, thank you for watching. Please do subscribe, like the video, and I will chat to you all soon. Bye.